This is part 2 of Beginner's Guide to Successfully Manage Mutual Fund Risk. In the part 1 video, we covered various types of risk and how to measure the risk. This is a continuation video. For those who missed the part 1, we recommend to watch part 1 and continue watching this video. In this video, we will be covering Riskometer. Welcome to holisticinvestments.in. Introduction to Riskometer 2013. In the year 2013, SEBI introduced the Riskometer to assist investors in evaluating the risk associated with mutual fund schemes. Initially, it used three colors to represent various risk level across different types of mutual funds. Blue for low risk fund, typically of debt funds, yellow for medium risk, typically of hybrid funds, and brown for high risk for equity funds. However, this version lacked granularity within asset classes. Next, revised Riskometer 2015. In the year 2015, a revised Riskometer with 5 risk levels was introduced. Despite improvements, it remained static and failed to account for risk variation within asset classes, primarily determined at the time of new fund offering (NFO). This limitation became apparent during the 2015 debt fund crisis, notably with JP Morgan Mutual Fund's challenge due to the credit rating downgrade of Amtech Auto. Next, trigger for change 2020 Franklin Templeton crisis. The 2020 Franklin Templeton debt fund crisis, where liquidity issues led to halted redemptions, exposed persistent flaws in the Riskometer. This crisis emphasized the necessity of addressing risk within asset classes and incorporating changes in bond portfolio quality over time. Next, mandatory dynamic Riskometer from January 2021. As of January 2021, a mandatory updated version of Riskometer was implemented, bringing significant changes. It expanded the number of risk categories to 6: low, low to moderate, moderate, moderately high, high, and very high, with overseas funds designated at risk level 7. Risk assessment was based on the actual portfolio at the NFO, and fund houses were mandated to use SEBI provided formulas for evaluating debt portfolio risk. Monthly evaluation and uploading of portfolio risk on the AMFI site were also required, along with tracking changes in risk metrics throughout the year. Enhancing transparency and risk management. These modifications aimed to enhance transparency and improve risk management for investors and advisors, particularly crucial in debt funds where portfolio quality can undergo significant changes over time. During the 2020 Franklin Templeton crisis, an analysis comparing the old and new Riskometer showcased the efficacy of the updated version. It provided a refined assessment, empowering investors to make well-informed decisions considering the dynamic risk profiles of their investments. The revised Riskometer marks a substantial advancement in promoting transparency and managing risk within the mutual fund sector. Understanding how to utilize the Riskometer is crucial for modern investors seeking to accurately gauge investment risk. While equities are commonly associated with risk, it is essential to recognize that debt funds can also present challenges due to the fluctuating worthiness of underlying bonds. The Riskometer serves as a valuable tool in assessing the risk level of debt funds, with the ratings of 1 or 2 signifying low risk options. Monitoring these ratings regularly is akin to staying updated on changing weather patterns, ensuring a safer investment journey. SEBI plays a crucial role in safeguarding investors by enhancing the safety of debt funds, as some firms may attempt deceptive practices to showcase better returns. Additionally, aligning the risk level indicated by the Riskometer with your investment horizon is vital. Funds required within 3 years should ideally have low or low to moderate risk indications, while those for longer term goals can tolerate higher risk levels. Ultimately, as an investor, we need to understand the risk and use the available tools efficiently to mitigate it. Next, we shall discuss the 3 effective ways to mitigate risk in mutual funds. First, low risk tolerance, designed for novice investors seeking minimal risk exposure. Check our blog How to Invest in Mutual Funds Without Losing a Single Rupee. This investment guide focuses on strategies to secure modest return without risking capital loss. Next, diversification, highlighting the importance of diversification in risk management. This approach spread investment across various asset classes to navigate volatility and seize opportunities for growth. The image given here clearly represents that with diversification, you can chase away any bigger risk even though your percentage of allocation is small in size. Next, utilizing metrics and tools like the riskometer aids in assessing and managing investment risk effectively. These tools help us navigate the rough sea with ease and figure out the risk profile of the investment. We would like to conclude that keep in mind every investment carries some level of risk. Despite claims of risk free high return schemes, it is essential to recognize that higher returns often come with increased risk exposure. It is crucial to acknowledge these realities and focus on building a robust investment portfolio accordingly. Seeking guidance from professional financial planners ensures a prudent approach to building a robust investment portfolio. Happy investing. A detailed blog post on this topic is available in our website. The link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.